Welcome. Today we'll be looking at 5 stocks which are trading near their 52-week lows in November 2024. First off is the famous Celsius Holdings, ticker symbol CELH, which is of course in the energy drink industry. Now this company has been getting a lot of hype recently. People believe that it's undervalued because it is down over 41% in the past year, and even more when we look at its all-time highs earlier this year. As a consequence, their valuation ratios have been going down consistently, where it was most expensive in Q3 2023, and currently it is roughly trading at around 50 price to earnings ratio and a 50 price to cash flow ratio. Now, of course, this is still a very hefty premium to pay on a company like this, but this is because it is considered a growth stock and it is growing at a pretty fast pace. Now, this company does not pay dividends. They choose to reinvest everything that they make back into the business. And this is how they've been able to grow their revenue, their gross profit, and their net income at such a fast pace in the past 2 to 3 years. Now, one of the main factors that has caused this stock price to drop is that people believe that they will now start to grow at a slower growth pace than they had been growing in the past. However, we can see that both their top line and their bottom line are growing consistently and that their margins are staying very consistent throughout the different quarters. This is extremely good for Celsius because having a net margin of around 20% for a company in the beverage industry is extremely difficult. When we look at their cash flow evolution, it is all over the place. However, since they're currently at this stage where they reinvest everything that they make, we aren't too focused on this. We should be more focused on companies generating a lot of free cash flow and being consistent with them when they're actually repaying it back to shareholders in the forms of dividends or share buybacks. And finally, I love that this company has such a solid financial position where their total assets are way above their total liabilities, meaning that they shouldn't be worried about liabilities anytime soon. Now in number 2 we have Enphase Energy, ticker symbol ENPH, and this company has been a roller coaster for the past couple of years. The fact is that this company has been having rough quarters with their earnings being very close to zero, sometimes being negative, and this is what is causing their price to earnings ratio to be all over the place, where it looks like their price to earnings ratio from September or October 2024 rose actually to the highest level in the past year, while their price to cash flow ratio stayed more or less consistent. This usually means that their net income has suffered in the previous quarter, while their cash flow has stayed relatively consistent. Now, this company of course does not pay any dividends yet. They want to first grow out their net income and have more consistent bottom line before actually doing this. And the fact is that they have been actually managing to grow their revenue, their gross profit, and their net income in the past 3 quarters. We can see that Q1 2024 was a bit tough for them, but they are on the right track currently because they have a mix of top line growth, margin expansion, consistency, and growth in their free cash flow generation, and their financial position is extremely stable. We can see that their margins have grown and are now at around 16%, that their free cash flow evolution is extremely consistent and predictable, which is something we love to see, and that they can pay their total liabilities with their total assets and still have some to spare. Now number 3 is Merck Company, ticker symbol MRK. And this company had an amazing start to 2024. However, the second half of the year has not treated them so well as they're now back where they started in November 2023 near their 52-week lows. Of course, we can see that their highest price to earnings ratio actually happened in Q4 2023, but this was more due to an issue with their net income, as we can see that their price to cash flow ratio actually stayed pretty consistent. This company is a recognized dividend payer and they have been doing so for a very long time, and they currently have a very juicy 2.96% dividend yield, which has grown at a 6.1% 3-year CAGR. And the fact is that although this company is not a massive growth story, they're very consistent with their top line, their bottom line, and they're able to maintain very high margins for a very long time period. For the majority of their quarters in the past year, they have had a net margin of around 40%, which is extremely solid. We can see that they're very good at generating their free cash flows. However, in Q4 2023, they had a slip up because their net income was actually negative as well. However, if this company returns to their predictability in their free cash flow generation, this could become very attractive. And finally, they have a very solid financial position with having almost 2 times their total assets as their total liabilities. Now, company number 4 is the famous Estée Lauder, ticker symbol EL, and it is in the beauty products industry. This company has not stopped falling since April 2024, and it is having a lot of trouble with their bottom line. This company used to be extremely predictable, extremely consistent, but they're having big trouble since the end of 2023. We can see that their price to earnings ratio is extremely high for all the previous quarters in this year. This is mainly due to their net income being extremely close to zero and them actually trying to recover from this situation. On the other hand, they're still paying a very good dividend, closing in on a 3.03% dividend yield, which has been growing at an 8.5% 3-year CAGR. However, my question is, will they actually be able to maintain this dividend while their net income is negative and their free cash flow is not as high as the dividend they're paying? Well, not for a very long term. So unless they start to do things right and they start to improve that net income, I believe that that dividend may be at risk of being cut. We can see their negative margin evolution, where it has been extremely close to zero for all quarters in 2024, and in this past quarter, it's actually become negative, meaning that they came in at a loss. Now, their free cash flow generation has actually also been all over the place, being negative in Q1 2024, rising for some quarters, but it is not very predictable. And the one thing that this company has going for them is that their total assets are still above their total liabilities. However, this difference was a lot higher in Q2 2024, and since then it seems like their total liabilities have increased while their total assets have decreased, worsening their debt to equity ratio. And last but not least, we have Genuine Parts Company, ticker symbol GPC, and this is in the automotive parts industry. This company had been having a pretty solid 2024, however, their stock got punished big time in their latest earnings report. Now, this company is not a growth story. It has been growing in line with inflation for the past couple of years, and due to that, their valuation ratios are pretty stable and pretty low, with their price to earnings ratio being between 12 to 18 times for the past quarters, and their price to cash flow ratio being a bit underneath. However, due to the recent decline in price, this company is currently yielding a 3.46% dividend yield for a dividend that has been growing at a 6.3% 3-year CAGR. Not bad. The question here is about guidance and about future growth, because in the past, their revenue, their gross profit, and their net income have been staying extremely consistent every single quarter. As I told you, this is not a growth story, so we shouldn't expect 20% increases in revenue from one quarter to the next. However, we should expect a consistent year-over-year growth from this company. Thankfully, we can see that their margin evolution has been consistent, with maybe in Q3 2024 decreasing a little bit, but still being positive. I'm not a big fan of this company because I don't like margins to be so thin, because this means that any sort of inflation or other pricing pressures can get this company into trouble. However, this company is very consistent and very predictable at generating their free cash flows, which is great, and this allows them to actually pay that juicy dividend that they're offering at the current moment. And finally, again, this company has higher total assets than total liabilities, which represents financial safety, at least in the short to mid-term. So before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, thank you so much for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.